$460 million. Gone. Not lost in a market crash. Not erased by a rogue trader. Not the result of a geopolitical black swan. Gone because one technician forgot to update one server. 45 minutes. That is the entire runtime of this catastrophe. The time it takes to eat lunch, sit through a meeting, watch half an episode of television. In that window, Knight Capital Group, one of the most dominant market-making machines ever assembled, executed 4 million erroneous trades across 154 stocks, accumulated a multi-billion-dollar unwanted position, and wrote itself a one-way ticket to insolvency. This is not a story about greed. It is not a story about fraud. It is a story about something far more terrifying. It is a story about a ghost in the machine, and the total absence of anyone capable of stopping it. To understand how Knight Capital died, you must first understand what it was. In 2012, Knight Capital Group was not a bank. It was not a hedge fund. It was an infrastructure, a piece of load-bearing architecture in the American equity market, so fundamental that regulators and competitors alike acknowledged its systemic weight. Their aggregate trading volume, proprietary and customer-facing combined, represented approximately 10% of all listed U.S. equity securities trading, every single day. 10% of the entire U.S. stock market, executed by algorithms, fiber optic cables, and a taxonomy of automated systems so complex that no single human being held a complete operational map of the machine. That machine had a core artery. It was called SMARS, the Smart Market Access Routing System. SMARS was Knight's primary execution engine. Its operational logic was elegant in its brutality. Receive large parent orders, algorithmically slice them into smaller child orders, then route those child orders to external trading venues at machine speed for execution. Parent orders in, child orders out, executions confirmed, positions booked. Simple, deterministic, ruthlessly efficient. SMARS alone represented approximately 1% or more of all trading in listed U.S. equity securities. A single automated router, 1% of an entire national market. That is the scale of the nervous system we are examining. Knight's compliance posture matched the arrogance of their market position. When the SEC mandated Rule 15c3-5, the Market Access Rule, in November 2010, requiring broker-dealers to establish documented risk management controls reasonably designed to manage the financial and regulatory risks of automated market access, Knight initiated an internal assessment. That assessment concluded Knight was compliant. It was wrong. Catastrophically, documentably, irreversibly wrong. The written description of Knight's risk management controls remained incomplete and inaccurate well into the summer of 2012. Their primary position monitoring tool, PMON, was a post-execution system. It observed. It reported. It could not stop a single order from going to market. There was no automated kill switch linked to capital thresholds. Read that again. A firm executing 10% of the U.S. equity market had no automated mechanism to halt order flow when aggregate financial exposure exceeded acceptable limits. PMON relied entirely on human monitoring. And humans, as August 1st, 2012 would confirm, are catastrophically slow. The proximate cause of the Knight Capital disaster was not a hack, not a rogue actor, not a systemic market failure. It was a deployment checklist that nobody wrote. Context: July 2012. The New York Stock Exchange was preparing to launch its Retail Liquidity Program, the RLP, a new market structure initiative scheduled to commence August 1st, 2012. Knight, eager to capture this order flow for its customers, needed to upgrade SMARS to handle RLP designated orders. The engineering work produced new RLP code, clean, purposeful, designed to replace a dormant section of SMARS that had previously housed functionality called PowerPeg. PowerPeg was dead. Knight had discontinued it in 2003, 9 years prior. The code, however, was not dead. It had simply been abandoned in place, resident on production servers, callable and executable, a loaded weapon left in an unlocked drawer. There is a further compounding variable. In 2005, Knight's engineers had accessed the PowerPeg code to extract a specific function, the cumulative quantity tracker, which had previously told PowerPeg when a parent order was fully filled and ordered it to stop routing child orders. That function was transplanted, moved upstream in the SMARS code sequence. PowerPeg itself was never retested after this modification. The result? PowerPeg was now a headless system, a router with no stop condition, an engine with no governor. If activated, it would route child orders continuously, indefinitely, without any internal mechanism to recognize that the parent order had already been completely executed. This is the mechanism of the disaster. Remember it. We will return to it. Now, the deployment. Beginning July 27, 2012, Knight's engineering team began rolling the new RLP code to SMARS' servers in stages, a common, sensible practice known as a phased deployment. Over the course of several days, they updated 7 of the 8 SMARS production servers. The 8th server was missed. No second technician was required to verify deployment completion. Knight had no written procedures mandating a deployment checklist or a peer review for SMARS code pushes. Other groups within Knight operated with written deployment procedures. SMARS did not. 1 technician. No verification requirement. No written protocol. No independent check. The 8th server received no new RLP code. The old PowerPeg code was never removed. The flag that was supposed to activate RLP functionality, if sent to that 8th server, would instead trigger a 9-year-old, headless, unstoppable execution loop. On the morning of August 1st, beginning at approximately 8:01 a.m. Eastern Time, the Knight systems began receiving RLP-designated pre-market orders. SMARS processed these orders. The 8th server, running the obsolete code, began generating error messages. Automated email notifications, internally called BNet rejects, flagged an error described as PowerPeg disabled. 97 of these messages were sent to a distribution group of Knight personnel before the 9:30 a.m. market open. 97. Knight had not designed these notifications as system alerts. Personnel generally did not review them in real time. The messages accumulated in inboxes, unread, while the clock ticked toward the opening bell. The 9:30 a.m. market open arrived. Nobody acted. The bell rings. RLP-eligible orders began flowing from broker-dealers to Knight. The 7 correctly updated servers processed them without incident. The RLP code functioned as designed. Clean execution, correct routing, no anomaly. The 8th server functioned as designed too. The problem was that it was designed for 2003. Each incoming parent order flagged for RLP routing and processed by that 8th server activated the dormant PowerPeg code. PowerPeg received the parent order. PowerPeg began generating child orders and routing them to external trading venues for execution. And then it kept going. With the cumulative quantity tracker gone, transplanted upstream 7 years earlier, PowerPeg had no mechanism to register that the parent order had been filled. It received confirmation of executions. It ignored them. It interpreted each incoming parent order not as a one-time instruction, but as a perpetual mandate. It routed, and routed, and routed again. At machine speed. The scale of what followed requires a moment of deliberate arithmetic. Knight received 212 incoming parent orders processed by the defective server. 212. From those 212 parent orders, SMARS generated and executed over 4 million child order executions across 154 stocks. More than 397 million shares traded in 45 minutes. At the point Knight was able to halt the bleeding, it held a net long position across 80 stocks of approximately $3.5 billion, and a net short position across 74 stocks of approximately $3.15 billion. Unwanted. Every single position. The product of an algorithm executing a mandate that no human being at Knight had issued on that morning. The market impact was not contained to Knight's balance sheet. For 75 of the affected stocks, Knight's erroneous executions comprised more than 20% of total trading volume. 37 of those stocks saw price movements exceeding 10%, with Knight's executions constituting more than 50% of volume. Other market participants, pension funds, retail investors, institutional desks, received execution prices distorted by Knight's phantom orders. Some received worse prices than they would have in the absence of the chaos. Some received better. None of them knew why. Meanwhile, inside Knight's operations center, senior personnel were watching PMON, their post-execution position monitoring tool, display a rapidly metastasizing position in the 33 account. The 33 account was Knight's internal catch-all holding account. Positions piled in from multiple sources simultaneously, making it structurally impossible to rapidly diagnose the origin or nature of the accumulation. PMON experienced system delays during high-volume events. On the morning of August 1st, it experienced delays. The reports it generated were inaccurate. The limits it was supposed to flag were not displayed on screen. The personnel monitoring it were required to independently memorize applicable thresholds to recognize a breach. And it could not, under any circumstance, regardless of what it displayed, stop a single order from going to market. Knight's technology team was attempting to diagnose the problem in a live production environment. The machine was on fire, and they were trying to read the schematics. In one critical intervention attempt, the team uninstalled the new RLP code from the 7 correctly functioning servers. This made it worse. With the RLP code removed, those 7 servers now also lack the correct routing logic. Incoming parent orders to those servers began triggering the same PowerPeg activation pathway the 8th server had been running all along. The contagion spread. The order flood intensified. 45 minutes after the opening bell, Knight managed to halt the outflow. The 33 account held what it held. The positions were real. The losses were crystallized. $460 million. The SEC's Cease-and-Desist Order, issued October 16, 2013, is a document of forensic precision. It does not moralize, it catalogs. And what it catalogs is a comprehensive, multi-layered taxonomy of control failures that did not emerge on August 1, 2012. They had been present, documented, and unaddressed for at minimum the preceding 13 months. The Commission's findings identify 6 distinct violation categories under Rule 15C3-5 alone. Let us treat them with the clinical specificity they deserve. Failure 1. No adequate pre-order controls within SMARS itself. Knight had controls upstream of SMARS, its customer interface, its internal order management system. But SMARS, the router that physically submitted orders to external markets, had no sufficient output monitoring, no control comparing orders leaving SMARS against orders that entered it, no automated mechanism to halt SMARS operations based on its own aberrant output. Failure 2. No automated capital threshold linkage. Knight maintained position limits for certain trading groups. Those limits did not account for outstanding order exposure. They were not connected to any automated order blocking mechanism. When the 33 account began accumulating at catastrophic velocity, Nothing in Knight's architecture was designed to stop the bleeding automatically. Failure 3. Inadequate written description of risk management controls. The Compliance Department's written documentation of Knight's controls was materially incomplete and inaccurate through the summer of 2012. It omitted entire trading desks, including the Electronic Trading Group and the lead market-making desk. The CEO was informed of pending revisions before signing his annual certification. He signed anyway. Failure 4. No technology governance controls for code deployment or legacy code management. No written deployment procedures for SMARs. No requirement for peer review. No protocol mandating retesting of dormant production code after modification. The PowerPeg code had been accessed in 2005 and never retested. This was not discovered during any internal review. Failure 5. No incident response protocol. On August 1st, Knight's personnel operated without a documented procedure specifying when to disconnect a malfunctioning system from the market. The technology team made judgment calls, in real time, under conditions of extreme uncertainty and incomplete information. One of those judgment calls, removing the correctly deployed RLP code, accelerated the disaster. Failure 6. A defective CEO certification. In March 2012, Knight's CEO signed the annual Rule 15C3-5 certification. The certification did not attest that Knight's controls complied with the rule. It attested that Knight had processes in place to comply. The distinction is not semantic. It is the difference between certifying a parachute will open and certifying that someone on staff has read the manual about parachutes. The Commission's final sanction. A $12 million civil monetary penalty. A censure. A mandatory engagement of independent compliance consultants at Knight's sole expense. A cease-and-desist order. $12 million. Against a $460 million loss. A penalty representing approximately 2.6 cents for every dollar of operational destruction. The penalty is not the point. The penalty is a footnote. The point is this. Knight Capital's collapse was not caused by the absence of smart people. The firm was staffed by sophisticated engineers, experienced compliance officers, credentialed senior management. The CEO received sub-certifications from 8 senior employees before signing his own. 8 human beings, all of whom believed they were compliant. None of whom were correct. This is the definitive lesson of Knight Capital, and it has not changed in the decade since August 1st, 2012. In a fully automated trading environment, the organism does not fail when the algorithm fails. The organism fails when the humans who built the algorithm assume the algorithm is under control. A single missing deployment step. A single unreviewed legacy code module. A single inbound order flagged for a routing program that should not have existed. And within 45 minutes, a firm that processed 1% of the entire U.S. equity market every day became insolvent. The machine was not reckless. The machine was precise. It executed with perfect fidelity exactly what it was told to execute. The humans just forgot what they had told it. Knight Capital Americas, LLC. Censured, fined, absorbed. The machine is still running.